Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 a.m. on KATX and KWBY as Angela Robinson joins Stace Gaddy to share important financial information to help you live life on purpose, insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
Good morning, good morning, good morning. Welcome to the program. I'm Stace Gaddy. As always, it is a pleasure to be on Life Planning 101 with Angela Robinson from Kennedy Financial Services right here in Eastland. Good morning, ma'am. Brand new week.
Brand new week, and do we have a show for you this week.
Uh-oh.
We're really excited about this one. And I tell you what, our giveaways today are going to be awesome. I'm going to go ahead and tell you about them right this second because you don't want to miss these. There's two ways that you can earn a free giveaway, and both are going to have the same prize today. First of all, we're going to have some trivia at the end of the show. So, listen intently because we will give the answer to the trivia during the show, and the first person to let us know what the answer to that trivia is going to get the prize. And the second way that you can get a prize is the best question of the week. We award the best question of the week as second prize. And both of these, what we actually do, we've got a software that we can plug in your existing investment portfolio and crash test it. So it's pretty fun. So you could give us scenarios that you want to do. What if oil fell back to $20 a barrel? What if the stock market dropped 40%? What if interest rates went up 5%? What if inflation increased 5%? What if a Democrat got elected? What if a Republican got elected? So you have all these options that you can throw in this crash test system, and it's pretty awesome.
Yeah,
It
can we
kicks
just
back.
do that? That as a show one time?
That would be fun.
sounds like cool software.
Yeah, it is. It is a lot of fun.
By the way, sorry to interrupt you, but folks, you don't have this software at home. That's the point here. Kennedy Financial Services has the software.
That's right.
Special software.
Let us crash test your portfolio this week. Let's see what happens. So with that, be sure to listen in, and you can tweet us, Twitter at KFS Life Planning with your answers, or you can also email us, lifeplanning@Kennedy-financial.com, lifeplanning at KENNEDY-financial.com. So lots of fun stuff today, but we are going to be talking about your investments today, but we're going to in particularly be talking about municipal bonds. And just to kind of give you a little definition,
yes,
first of all, and then also reason why people would use municipal bonds and the history of municipal bonds. Municipal bonds have always been considered a safe haven, and I kind of want to back up to what a bond is. So, basically when you invest, you can invest one of two ways. You can have ownership, or you can provide loanership. So in other words, you can loan somebody something, or you can own part of something. So a bond is a type of loanership. So in other words, what you're doing, for example, let's say that it's a company, you would lend them money, say it was $30,000, with a promise to pay you interest only for the next 5 years, 10 years, 15, 20, 30 years.
Okay.
And then at the end of that period, the company has a promise to pay you back your original money. So it's a loan. It's just simply like an interest-only loan that has an expiration date. And that's what bonds are.
I've never actually really known how bonds work, so thank you.
Yeah. So pretty simple. Bad part about bonds is there's no collateral. It's not like a bank where when you take a loan on your house, they have collateral of your house and they could take that, right? So you take a little bit more risk. So what people do is they typically go to municipal bonds first. Why? Because these are typically governments and municipalities that issue these bonds. Mm-hmm. All right. So it's like if our town needed to raise some money, what they would do is issue a bond, right? And it's a municipal bond. First of all, that would seem pretty secure because typically governments and municipalities could pay back those bonds. They have it in their budget and how that's going to happen. But then also the federal government gives you some additional incentive here. There's a tax advantage to this. Any type of municipal bond investing, the investor gets tax-free interest.
Okay.
So that's great. So, just say, for instance, that you've got a bond that's paying you 4%, all right, and you're in the highest tax bracket that there is, which is right now 39.6%. And by the way, on investment income, if you're in that tax bracket, you're paying another 3.8% 4% for Obamacare tax. Okay, so typically, really,
Thanks, Obama.
Yeah, you've got an over 40% tax bracket. So if you've got over that 40% tax bracket, that 4% bond is really earning you a tax equivalent return of 5.7%. That's big. Another 1.7% on top of that.
Slaughtering CDs and savings accounts.
Oh, sure it does.
Yeah.
Sure it does. So, that sounds like a good deal, right? And
Sounds like it.
Yeah. How can it
I
get
hear
any
a
better? Yeah, there's a but a coming.
Yeah.
So, and that's the thing is how could it get any better? Actually, interestingly enough, had a gentleman in our office bring me something this morning. And he said, so my brother works on the base, and he brought me this file, and this is something that an insurance guy was selling him, and he was explaining it to me, and it sounded too good to be true. Can you please find the but? Okay, so where is it? Because no matter what you do, there's risk, and that's what you have to realize. So we're going to be talking about the risk of municipal bonds in this show in particular, but we're also going to touch on the risk of the stock markets today, so you don't want to miss it when we come back.
Angela Robinson, our guest and expert. You're listening to Life Planning 101, talking about municipal bond math. Take a quick break. Keep it right here. Welcome back in, folks, to the second segment of Life Planning 101. I'm Stace Gaddy, and here is our guest and expert once again, Angela Robinson.
Thank you, Stace. And we've got a great show today. We're talking about municipal bonds in particular, but we're also talking about risks in the market. Want to remind you, we're giving 2 free giveaways today. We're going to crash test your investment portfolio for you and see what would actually happen if. And you pick the ifs. If you can't pick the ifs, we'll pick some ifs for you.
I'm going to come and do it just to pick a lot of ifs.
I know. It's a lot of fun, actually.
Yeah.
It really is. The second thing is we've got a tweet going out today, all right? So be sure to follow us on Twitter at KFS Life Planning and answer our poll this week. Our poll is, which are you more concerned about today, running out of money or a stock market crash?
Okay.
So tell us, which one are you more concerned about today? So back to the show. Let's talk about these municipal bonds. We talked about, the fact that they're considered a safe haven just because they lend money to local governments and municipalities, which, Stacey, you asked me in the interim, how's that paid back? Well, that's tax increases mostly that pay for that. So this seems pretty safe. Second thing is you've got this interest that's paying you tax-free interest income. And then the second thing is if you look at the market, since 1980, municipal bonds have seen substantial upside. So not only are they paying this interest back, but if you actually trade them, you've been able to make money. Well, why is that? Why have you been able to make money? Let me ask you, over the past 10 years, have interest rates gone up or gone down? Down, right? So this is why. If I have a bond today that's paying 4%, and then there's a new bond that comes out tomorrow paying 3%, is my bond more valuable or less valuable?
Less valuable.
It's more valuable. Oh! It's more valuable, okay? Here's why it's more valuable. Think about it. Would you rather get paid 4% or 3%?
4%.
4%, right? So if I own the 4% bond and you can only buy new bonds that are 3%, you'd want mine, right? So you're going to pay me what we call a premium for that. You're going to pay me more for that, and I'm not going to let it go for less than that.
Right.
Because for me to go and reinvest in the market, I've got to buy a lower yielding bond, that 3%. That's been the case since 1980. Here we were, if you remember the 80s, double-digit interest rates, right?
Yes.
Okay? So we've went from double-digit interest rate paying bonds to today 2%. I want you to think about that. So that's a big drop. So that means this whole time bonds have been increasing. Now, do you think interest rates are going to go up or continue to go down?
Why are you testing me so much?
I know.
But they're going to have to go up.
They're going to have to. We're at a floor, right?
Yeah.
And if you think that we're going to have inflation, that is the Fed's number one tool to fight inflation. In fact, they already raised rates a little bit last year. So I want you to think about this. If let's flip-flop this case. Now I've got my 4% bond still, but let's say that a new investor can go and get a new 5% bond. Are they going to want my bond, my 4% bond?
No.
No, they're not. So what's going to happen to the value of my bond?
It's going to drop.
It's going to drop. That's exactly right. So remember that bonds have what we call an inverse relationship to interest rates. Here's an example of this. If you remember a few years ago, back in 2013, the Fed kept flip-flopping. Are we going to raise rates? We're not going to raise rates. We're not going to raise rates. We're going to raise rates. So it kept going back and forth. And they talked about tightening the fiscal policy the first time in the spring of 2013. Subsequently to that, okay, there is a municipal bond index called the Dreyfus Municipal Bond, and you can find it with DRTAX if you look up the ticker, DRTAX. It dropped 9% over 4 months when they just talked about raising rates.
Yeah.
They talked about it, okay? They didn't actually do it, all right? So if you think you've got a safe investment, you may want to think again about that. Now, here's...
May I time out quickly?
Yeah.
You're stuck with your bond for however long you've stuck with it, right? You cannot get out of it. Is that the thing?
You could get out of it, but you're going to get you're not going to be able to sell it for a premium or what you bought it for.
If you have a 4% one and a 5% one comes on the market, can I get out of my 4% one and get the 5% one if I want to?
You could.
But then
potentially, but you're going to take a loss doing it. So here is the thing. A lot of people that sell a lot of municipal bonds, and by the way, I'd always ask your broker, what's your history? What have you done? Or your investor advisor, what have you done? If they tell you, well, we do a lot of annuities, then guess what their solution is going to be?
Get an annuity.
Okay. If we do a lot of bonds, guess what their solution is going to be?
And so
bonds, right?
Yeah.
So it's kind of like if you go to a surgeon, their solution for everything is probably going to be surgery. So be careful of this because there are a lot of advocates out there for bonds. And here's what they're going to tell you. Well, it doesn't matter if you hold it to maturity. You'll receive back the par value, the face amount of the bond, the amount that you actually loaned. And that is a true statement. But it doesn't account for interest rates at all. Okay? Think about if interest rates rise. Why does the Fed raise interest rates again?
To avoid inflation.
That's right. So a 4% bond today might sound like a wonderful investment if you got that tax equivalent of another 1.7, so you got 5.7% paying bond. And then you take inflation over the last 12 months, what we just had, or the government tells us we just had as inflation, was 1.02. That's what they told us it was. So that would be what we call a real return of 4.68%. 5.7 minus inflation, 1.02. Because remember, inflation is that little thing that eats into your money. It's a thief of your money. If you go to the grocery store, you can't help if prices go up. I guarantee you cannot bargain that cashier to let you have last year's prices on that grocery that you need to buy.
No.
Okay? It's not going to happen. All right? So you have to account for that. So that real return is 4.68. But let's imagine that inflation rises to 4%, which maybe it already is.
Just don't know about it yet?
It's debatable. The government's not saying that, but you go to the grocery store, you tell me, what do you think inflation is? So if it was 4% and you had that 5.7% paying bond, what's 5.7 minus 4?
Right.
1.7%. That's all you made on that bond. And what if we go back to inflation like in the 80s? 10%. That's a negative 4.3% return. Okay, but you're stuck in there. But those advocates for the bond say, well, you'll get your money back. You will, but we call that going broke safely because you're not going to have as much purchasing power in 30 years when the bond matures.
If you have a negative return like that, do you have to pay that?
No, you don't have to pay it. It just means that your money's losing money.
Losing it.
You're
Okay.
losing purchasing power. Okay, if you go to $100, if you have $100 that you have today, and in 30 years you still have that $100, can that $100 30 years from today buy as much as the grocery store?
No.
You'll probably buy a quarter of what you could buy today at the grocery store. That's what it would do to your money. It's that going broke safely. So when we come back, we're going to wrap this up, and then we're going to get into the markets. You don't want to miss it, so stay tuned.
This is absolutely fascinating. Thank you so much. I'm learning a lot today, folks, and I know that you are too. Angela Robinson with Kennedy Financial Services, our guest and teacher. We'll take a break, come right back. Welcome back in, folks, to the final segment of Life Planning 101. It is a pleasure. I'm Stace Gaddy. Here is Angela Robinson talking about municipal bonds and all that go around that, and I have learned a ton today.
Yes, it is a great topic. It really is. And we, we talked about bonds. If interest rates go up, like they have already a little bit, what's that going to do to bonds, and particularly municipal bonds? And their values are going to go down, and the risk of holding them to maturity could be too high. And here's just simple. If you didn't get all that, let me just ask you one question. Okay,
let's boil it down.
Let's just boil it down. Let's say that we go back into an environment where interest rates are like they were in the 80s, and new bonds are being issued at 10% interest, and your bond pays you 2%. You going to be happy?
No.
Okay. That's all I got to say. All right.
I can understand that.
Okay. That's pretty simple, right?
I got it.
So question is where are they going to go from here? That's what nobody knows. That's the big question. And we do believe there's inflation ahead. We actually do. And, there's a study for those of you who have municipal bonds, because a lot of people who have municipal bonds, they tend to think, what I've done is really good. And you have been invested in one of the greatest investments over the last 30 years. Don't get me wrong. Mm-hmm. Okay. But things change. Environments change. And that's exactly what's occurring today. And there's a study that I've mentioned before on the show, behavioral economics, and it talks about how humans tend to think and why they behave the way that they do. And one of these is what's called a normalcy bias. And a normalcy bias is the refusal to plan for or react to a disaster that has never happened before. Okay?
Yes.
And because you may have been an investor over the last 30 years and you've never seen municipal bonds move in any other direction but up, they seem like a safe haven and it's okay. Well,
we were talking during the break about the subprime mortgage bubble burst.
That's exactly right.
Same behavior.
Same exact thing. Okay. So,
normalcy.
And you just gave a great segue into what we do want to talk about with the markets, because, here we are. This last 12 months has been a little bit of a shaky area with the markets. I think we would agree with that, right? And so everybody's kind of like, what do I do? Well, there's good news. The markets are up over the last couple weeks. We're actually flat for the year, mostly in the U.S., just depending on where you're invested. I think small caps might still be off a little bit, and some tech stocks, and of course, there's those individual stocks that may be off, but most of the indices are flat for the year. So I want you to take action right now. I want you to think about something. When 2008 occurred, we all remembered that, and the market dropped between 2008 and 2009, 38%-ish. I want you to think, was there more risk in the market in the summer of 2008 before the market dropped, or at the bottom of the market in 2009, in March?
More risk before.
Before, that's
yes.
right. And oftentimes we don't think of things.
You're making my head hurt today.
Yeah, I might be. But, oftentimes we don't think about things like that. So I want you to think about looking at your portfolio right now and considering what the risks are in that portfolio. Warren Buffett. We all know who he is, supposedly the greatest investor of all time. He's a billionaire, made his money on the market, okay? And he has some simple philosophies that we should all follow. He doesn't fall in the traps of behavioral investing. But he has a statement I love. It says, predicting rain doesn't count. Building acres does. Okay? So you got to build your acres here. We can't predict that the market might keep going up or that it might go down. You've got to plan for both. You've got to build your acreage out wisely to be able to cross fence if that's what you need to do, plant some fields this year if that's what you need to do to make sure that you're okay. Because what is the biggest threat to your investments right now? What would happen if oil went back down and we're at $20 a barrel? We just saw what happened the first time around when it dropped. What would happen if they raised taxes? What would happen if we entered hyperinflation and those interest rates go through the roof like we talked about earlier? What if our country was attacked? What if another country had a major economic meltdown? Do you think that would affect us?
These days, the global market.
It is, and we got to think about things that way. So I encourage you to remember 2008, and I don't want you to be worried. You should be sleeping at night, but I'm going to say don't sleep at night until you know that your portfolio is the way that it needs to be. We have taken extra caution over the last 6 months to make sure that all of our clients are positioned for these what ifs. Reason why? There's never been a continuous bull market for over 7 years. And where are we entering?
Year 7.
Okay. All right. So what is the smart thing to do?
She's just seeing if I'm paying attention.
That's right. So answer our tweet. Which are you more concerned about? Running out of money or a stock market crash? It's at KFS Life Planning. We want to hear your feedback. And here is the trivia.
What's the trivia?
This is the trivia for a free crash test on your portfolio.
Okay.
Email us, lifeplanning@kennedy-financial.com, or tweet us at KFS Life Planning. And here it is. When was there more risk in the market? March of 2009 or August of 2008?
Come on, guys. This was toward the end of the program. I actually answered the question correctly.
Yes.
You know this one.
Yes, you should know this one. Be sure while you're at it to like us on Facebook, facebook.com/Kennedy Financial. We've got lots of great posts that come out throughout the week. We're very proactive. We want to keep everybody in tune with what we're doing. We also have a weekly newsletter, so let us know if you want to get on that. Kennedy-financial.com. We post usually a life planning thing, something that's in the 8 life planning issues, and then also we've got a market commentary on there every week. So don't miss that. That'll be great. And next week, we will have our special guest, certified financial analyst Aaron Kennedy, on the show. It's going to be sharing with us about what is going on in the markets. You don't want to miss it. We sure do appreciate you listening to the show every week. And don't wait for the bandwagon to occur. Go ahead and follow the advice of Mr. Buffett. Let us help you build acres this week. My name is Angela Robinson with Kennedy Financial Services. God bless, and God bless our country.
You are absolutely excellent. Do you know
thank
that?
you. Thank you,
Do you know
Stace.
that?
Thank
No,
you.
seriously. I never get a chance to say that publicly on the air because, we run a pretty tight program so that we're in time and everything. But honestly, you are and your family just excellent. Let me ask you quickly before we go, the name of that study again, that behavioral study. I think everybody should become aware of that because that transcends all kinds of things.
Absolutely. Behavioral economics. And we talked about normalcy bias today. There are so many biases to read about and to know about yourself. The more you know about yourself, the better that you're able to separate your emotions from logical decision making. Very important.
Very, very, very important, folks. Thank you, as Angela said, for joining us today. We'll come back again next time for more Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Securities and investment advisory services offered through VSR Financial Services Incorporated, a registered investment advisor and member of FINRA SIPC. Kennedy Financial Services is not owned or controlled by VSR Financial Services Incorporated.